Hello, Bloke here, and this is part two of my musings, and this follows on from my earlier video where we will cover agronomics, or just sort of quick update on agronomics anyway. So this is a 2024 idea that was also a bargain shares 2025. Last year did very well, top performer of the 2025 bargain shares, 63% return. So far this year is up 1.6%, and I think the point I would make here is that of the 6.5p share price, 3.4p is Liberation Bioindustries. That's now on the cusp of opening its first facility. It's building a second facility in Saudi Arabia and reached several milestones. So I think a large part of the share price is covered by this, and I'm pretty excited about this and the profitability that this can make. And certainly when you see that over 50% of the share price is covered and 50% of its forward production is already contracted, that all feels very, very positive. So that's going to be a 600,000 litre capacity downstream processing, and even just this on its own could justify the share price. And then Agronomics also then has a series of other holdings and companies that it has shares in. So yeah, I remain very positive. I mean, they did kitchen sink a lot of holdings that hadn't done well, rather than keep them there in limbo. It's just put a knife to them. Like, let's just get rid of the dead wood, I guess. So it has meant a 20% reduction in the NAV, down to 12.34. But look, I mean, it's still at 50% discount, where, as I say, I mean, even just single shares could easily justify the share price. And I think what I would also talk about is that uh, the bit that I think isn't getting discussed today. We're talking a lot about metals and the strategic importance of metals. We're talking a lot about why, in my last video, I was saying the price of tungsten more than, I think, increased by 700% during World War One, when the ships containing tungsten ore started getting torpedoed, going to the bottom of the sea. And we then had a shortage of tungsten, the price of tungsten shot up. Well, that's all well and good. And if you're short of metals, then that can be pretty difficult for the war effort or for strategic reasons. But the bit that we forget as a nation, I mean, Britain was within a few weeks of starvation, was that strategic importance of metals is one thing, and it is important. I'm not saying it isn't, but strategic importance of food is critical. Without food, like that, any country can be brought to its knees without food, without access to food. So having something like agronomics, which is ultimately a way of generating food, potentially generating food without the means to generate food. So what I mean by that is that not every country in the world is blessed with green fields and highly productive, sort of, land to grow the beef and the crops that are required. And we've reached a point. I think we've reached a point where the number of the amount of land that is set aside for farming, for agriculture, is at its maximum. Any increase to the amount of land set aside would be devastating to the remaining wild, jungles and pristine rainforests and so on. So there's not really the scope to chop down more trees and chop down and clear more land for agriculture. We're sort of at that maximum point. So the only other way of providing enough food would be through technology, and this is what agronomics is all about, and particularly around ingredients and foods that are maybe that there's right now where there's not a question of what texture is it there, and pet food being an example of this. I mean, just the number of pets that there are in Britain, and let alone Europe, let alone the world, that the and of course pets generally are meat eaters. I mean, they don't get to be vegans or whatever, because that's like you're not going to have a healthy pet if you do feed. I mean, I'm probably going to get somebody writing in saying you're talking a load of rubbish, but I mean, animals are, meat eaters. I mean, dogs come from wolves, and wolves are meat eaters. I mean, they are apex predators, um, ultimately. So yeah, I think the we take our food for granted, and perhaps we shouldn't, and perhaps agronomics as a long-term idea with long-term potential, the strategic importance of food cannot be underestimated. And I guess make the point, but also just the price of food. I mean, the price of food in restaurants, the price of food in supermarkets, that's for example the price of beef. So in the space of a few years, beef has more than doubled in 5 6 years, more than doubled. And where's it going to go next? What's the price going to look like in 2027, 2028? I, I just don't think beef is going to go downwards, because there's so much pressure on food chains I think that agronomics kind of feels like you're betting on Christmas being a colder season. It's kind of inevitable. It feels inevitable. And that's, there's no great research or deep dive there. It's just the point that I'm making, that agronomics does play into a very important macro. So next one I'm going to cover is silver and SilverCorp. Um, so obviously last week and the Friday before, there was a lot of volatility, price going up and down, and silver moved, dropped dramatically, increased, reverted dramatically, dropped again, reverted again. Very large percentage changes. But overall, if I compare to 6 months ago, silver silver has moved from $35. So 6 months ago, what was happening 6 months ago? 6 months ago, we were in the period ending the 30th September, more or less. I mean, it's 5 months ago, not six, but it's it's, well, 4 months ago, four and a bit months ago. But 6 months ago, we were in quarter three. We're now in quarter two. Also, no, we're not. We're in quarter one. So we were sort of midway through quarter three. So back then, 6 months ago, silver was at $35. Today it's at 77. Friday's close price. Meanwhile, and again, there were some variances, but roughly for the silver producers in my universe, so SilverCorp being one of those, roughly something like a $22 to $25 all-in sustaining cost. So what that what those two little nuggets of facts mean is that silver miner profits have grown from $10 per ounce to about 52, okay, per ounce pre-tax. Obviously tax comes out of all of that. So that's that's a 500% change. Okay, that's a 500% change. Yet, when you actually look at silver miners versus the price of silver, okay, uh, silver miners have not increased by 500%. Silver miners, the maximum they've changed by is 200%. And SilverX remains at a large discount to its net asset value, and there are some reasons for that. What I thought was absolutely shocking was this one, Luca. Now, these are not UK listed shares. Luca is Canada, so CA.LUCA. Um, uh, uh, But when you look at Luca's 12-month performance, at the end of 2025, they said the past year we've produced 26,144 ounces. Our guidance was this, so they're above their minimum of guidance. Okay, they've produced 1.33 million ounces of silver, meeting the revised guidance of 1.18 to 1.4, so they're almost at the top end of that guidance. Yet the share price over 6 months is up 14%. I, I mean, it just baffles me that it's up by such a small amount. And here they all are, by the way. So AGX is SilverX, SCZ is Santa Cruz, SVM is SilverCorp, SLVP is physical silver. So you can see here, physical silver is this deep red one. I mean, this has gone up from 35 to 77. It says 98%. So it's a bit more than, or it's a bit less than 35 to 77. So I'm not sure why that is, but that's maybe because it's 6 months. So 6 months would be the 8th of August. So I think maybe I'm sort of taking I don't know why I'm not quite getting the right 100 and something percent. But anyway, so silver core has only gone up by the price of silver. SilverX has gone up by twice the price of silver, but a lot of that was that SilverX was just making no money whatsoever, and now they're sort of just about breaking even. Santa Cruz, I've written about this one, it has obviously increased it by a bit more, but not by a lot more. Luca, meanwhile, I mean, you can sort of see here it dropped down and has sort of made a bit of a recovery, but is down. And also Cerrado. Cerrado is down 22% over 6 months. Now, the reason for this drop was that the Portuguese government have said that they've now it's a slightly strange story, but having designated Lagoa Salgada as a strategic project, a European strategic project, and also having rules whereby the Portuguese government had, I forget the exact number, but it was X number of months to lodge any objection. That time came and went, but after that time came and went, they then lodged an objection. Despite it being designated a strategic project, despite it being outside the timeline for them to be able to do so, they did so. So it's kind of a little bit up in the air, but if that gets resolved, and personally, I just don't see how it won't be resolved, A, because it's a hugely strategic, important project for silver, but also for copper, also for other strategic minerals. It's a very large project. It would be a key project for the Europeans. The also it's just the amount of money involved. The I think it's University of Lisbon are deeply involved in mapping it out, and so it's an important project for Portugal's economy, but also the legality. I mean, if your own law says that you've got X number of months to designate something as having an objection, and then you don't follow your own rules, presumably that can be challenged in a court of law and will be. So we'll see what happens there. Luca, meanwhile, I mean, Luca basically ran into all manner of, it had dilapidated equipment, so spent a lot of money on sustaining capex and improving its production, improving the reliability of its own equipment during 2025. So yeah, it's not, share price isn't up by very much, but yeah, certainly I sort of look at all of these and say to myself, well, you know, compared to the amount of profit that these can now generate per ounce, the share price has not reflected that whatsoever yet. Now, obviously, if silver drops back to 35 an ounce, then, well, okay, that's the end of the story. They should be at 0% increase over 6 months. But I think when you look at the degree by which the silver price is being supported as it gets sold down, um, the amount of support pushing it back up again is very strong. I just don't think it's going to, it's just my opinion and this isn't advice, but it doesn't feel like it's going to drop back to 35. I don't see how it can. If you look at physical demand and supply, I don't think it can because the demand is too strong relative to the supply. And yes, I mean, these companies are now making some good cash flow. But as I say, I mean, Luca, dilapidated equipment on its knees, SCZ not much better, AGX absolutely on its knees. Really, like it's not as though these companies have got vast pockets full of money that they've been like able to respond to an increase in demand for silver. You know, and these are the primary silver producers. I mean, for those that are doing silver as a byproduct, say a byproduct for zinc mining or copper mining, well, the fact that silver's increased or decreased in price doesn't really matter to a copper miner. They're going to be focused on copper price, and they'll increase or decrease their production because of that, really. And the byproduct credits are just a nice to have. They're not central to the decision making. So yeah, I thought that was interesting. I thought that as well, SilverCorp has given its operational results, hasn't yet given its financial results. They come on tomorrow evening, Monday, the 9th of February, after market close. But what we have been told is that revenue for the third quarter of 2026, which was the period ending 31st of the 12th, 25, increased by 51%. So gross profits, therefore, probably will have doubled to eight. This is what I'm anticipating, forecasting. Profits will have doubled to about $80 million, which perhaps, again, forecast net income might be 55 million, which is 220 million annualized. So that puts SilverCorp at a price earnings of 10 times. But this is before its new mine in Ecuador comes online later in 2026. So you can see here, I mean, that is going to, I mean, again, these are the forecast numbers from just taken straight from ShareScope. So these aren't my own calculations, but just to kind of give you an idea, I mean, the new mine coming online is going to make a massive difference to profit. And they've also acquired a further mine in a place called Kyrgyzstan. So El Condor, yes, there are some additional capex costs of about 40 million, which is a one-off cost. It's also spent 162 million buying two projects from Charat in Kyrgyzstan, where take a look at these numbers. So at 4,500 gold, so obviously that's below today's gold price. The 3 to 4 year net present value is 700 million net present value. So, and then Kizil Tash, clear path for full permitting, roughly 200,000 kilo ounces a year, 18 years, a 2.5 billion net present value at 4,500 gold. So, I mean, the payback on those for that 162 million to get 3.2 billion back over the life of mine, payback's about 10 months, 10 to 15 months. And yeah, I mean, gosh, I'm looking forward to seeing the results from SilverCorp, the financial results. But again, just going back to my point that this is tracking the price of silver. It's not whereas the profits are leveraged to the price of silver. Now, in the period to December, we only see a 50% increase in profits, but yeah, and obviously, there's other things, other moving parts to this that it's polymetallic and other things. So, but it does give you a bit of an idea that not all of the opportunity has gone out of the market. Far from it. I mean, certainly when you look at how things have. I mean, and I'm finding this incredibly useful to look at shares over, say, a 6-month period compared to the price of the metal that they are mining, that you kind of look at this and you can spot opportunities. I mean, looking at whether something has gone up or not gone up in price relative to itself is less instructive than mapping out its production. What's the price of it per ounce that it's producing? What's the price of it compared to the price of the metal? These other metrics are proving to be very, very useful to understand the dynamics of the market. That was all I was going to say on that. The next topic was just following on from my hung out to dry article this week, that um, it's interesting about the different people and their reactions to the news about the drop in share prices at, for example, HG Capital Trust, which I bought into at a 26.6% discount and felt that the drop was completely overdone. I must admit, I did look at some other ideas, and in fact, one of my readers did write that commentary was made about the negative drop in demand from, for example, estate agents and Rightmove, or car dealers and Auto Trader, where the perception is that the increases to the subscription cost for a customer of those are too high, that they are, inverted commas, being too greedy. I haven't really got a view on whether that is or isn't the case, but that's the feedback. So, like in the case of HG Capital, I'm not kind of subject to greediness, because I feel that um, the software markets are reasonably competitive, where you can't go increasing your prices willy-nilly or by silly amounts, because um, businesses will and do have options to swap over to competing platforms. My point, though, is that I don't fundamentally believe that businesses will just willy-nilly swap over to other platforms um, just because they exist. That human nature is that people will remain tied in to packages for years and years, and really only change when there's a compelling reason to change. In other words, if they are delivering what they need to deliver, if it's, I don't know, a health and safety system that they're not, I don't know, they're sort of able to run their health and safety function reasonably well, and they don't feel any pain points to using it. And will AI and agentic AI make a difference to how these software get used? Yes, absolutely. Could it mean a difference to the interface? Yes, it could. Like, could I chat to my software? Could I use words to chat to my software rather than typing on a keyboard? Yes, that's probably going to come. Will I be able to, I don't know, design like a front end interface to talk to my software in a better way? Probably. Will I be able to generate reports and visualizations to my data using an agentic AI? Yes, probably. Will I be able to automate things that currently I do manually? Yes, probably. But the software is still there. The software doesn't get replaced; it just gets enhanced through agentic AI. And I think that's what's been missed. And I remain of the view that my position that I've taken into HG Capital, for example, is extremely defensive. And I mean, yes, I'll eat my Paddy Ashdown hat if I'm proven wrong on this, but I just don't think I will be, or at least not like overnight. Like in the next year, it's still going to generate a rule of 44. It's going to have 33% EBITDA and about 10%, 11% growth. Um, and I think that's just going to carry on. I just do not see that there's going to be some vast change to the fortunes of software companies. Incremental change, yes. But what you've got to realize is software companies are already under vast amounts of competitive pressure. At least I think so. That I don't see that it's some sleepy, monopolistic position. These software companies are constantly innovating to remain relevant, to remain best of breed, and so on. I do think that's the case. I don't think. I mean, could there be some very specific? Could there be some very specific upsets? yes, I think that it's a matter of time until the Windows operating system dominance becomes challenged. I think the search market's dominance is definitely challenged with AI. So Google's dominant position is threatened. I think the Mag 7 are under threat from software, but I don't think a lot of the smaller softwares are under threat in the same way. Is my view. But I'm going to play around with Anthropic and let's see if I can prove myself wrong. I shall undertake an experiment. I'm not going to say what I'm doing particularly, but I'm going to just play around with it and let's see whether I change my mind. And obviously, if you've got further evidence or something that you feel is relevant to add to that conversation, I mean, do feel free to use the comments and drop a note and so on, as is always the case. Next thing I wanted to talk about was Turkey. It isn't actually anything to do with teeth. It's the Turkey ETF. Quite a number of people were very negative about this. They said, "Oh, yeah." Turkish businesses are on their knees and they make no money. There's all sorts of corruption. There's this, there's that, there's the other. Okay, yeah, maybe your experience of particular businesses. I don't know if you've been to Turkey and you know the guy that runs the corner shop or whatever it is. I mean, you've obviously got certain opinions and certain views, but I'm looking at this from the point of view of, well, I'm interested in the companies that are inside that ETF, and particularly the ones in the top 10 of that ETF, because they're the ones that are the most relevant. And all I can see is good news, and the share price itself is up nearly 20%. And I've just included, companies like Athelstan, Turkish Airlines, companies that are sort of at a fraction of the price of their equivalent British or US company are world-class companies that are at bargain prices. So it's a couple of headlines that I grabbed from a Turkish news website. Turkish unemployment drops to a 25-year low. Turkish defense exports jump over 44% to a new January record. Heathrow is still Europe's busiest airport. And I think Heathrow reported something like, I can't remember, maybe it was 2 point something percent increased passenger traffic. But I mean, every time I see anything about Heathrow, it's always framed as a negative. There's no national pride to the fact that we've got the busiest airport, Europe's busiest airport. It's a source of national angst. Whereas the Turks, I mean, they would love to have the busiest airport. They're chuffed to bits that Istanbul draws nearer. And has every intention of overtaking London, overtaking Heathrow, and I think they will. And when that happens, well, I'm sorry, but you're not going to be the leading economy when you've got a backwater airport. And these things that we take for granted and have allowed to be eroded. I mean, shame on us, basically. Anyway, that's enough on Turkey. I just thought I'd mention that. I also wanted to cover the works. So there was an interview of Mr. Rebel and his view on the works. He presented that in an interview, called it crazy cheap, PE of 3 times, market cap of 18 million. So net profit of 6 would be a PE of 3 times. The contention was that no one believes the E of the PE, so no one believes that the earnings are real. And I kind of thought about this. I was like, really? No one believes that. Well, I mean, let's kind of examine the evidence. Let's read the accounts. So last year the adjusted EBITDA was 9.5 million. This year, the works say that they're on track for an 11 million adjusted EBITDA. The net profit last year with the 9.5 was 4.4. Okay, so they delivered a a really strong result. And 4.4 on an 18 million is a PE of 4 times, of course. I mean, I don't need to tell you that's obvious. So the profits are up. Bit profits are now, these are not finalised because, of course, we've still got the final 3 months to go, and this was as at the middle of January. You can sort of see here, remained on track to deliver FY26 profit in line with expectations of 11 million, and then further profit growth in FY27, but remains on track. Basically, we've gone through Christmas. Christmas is the busy period, so we've got kind of like the remainder, which is the remaining 3 months, which is probably a quiet period. So maybe 10% of revenue, something like that. So 90% certainty, let's call it like that, that they are on track. We also know that finance costs were higher we've got the interim accounts, but we know that the operating profit was 1.85 million stronger in the first half. It was a loss that was 1.85 million lower than the first half of the last year. So the first half of the last year, when overall for that year they made 4.4 million net profit and 9.5 adjusted EBITDA profit, they are 1.85 million ahead of that position. That's important because post-tax, I mean, that is about 1.4 million net profit ahead in the first half. Okay, or in fact, it's not approximately, it's that they are 1.4 million ahead. So if they made 4.4 last year and they're 1.4 ahead, 4.4 plus 1.4 equals 5.8. Yeah. We also further know that they are like for like ahead compared to last year because they told us so. It says so here, look, robust L for L sales up 1.2% for the Christmas period for the 11 weeks, with disrupted online sales down 51.8. Well, 51.8 that's 10% of the revenue. So that's kind of like -5, whereas the stores are 95. So, 1% of that is going to be plus 1.3, say 1.4. So overall, strong margin growth and cost savings. We know that the margin growth is about 2%, which is then another 6 million. So when you actually add all of that together, and again, we know that the first half loss was 0.5 million on the online, and they said it's going to be a lower loss than last year's loss, which was 1.2. So again, we've got some frameworks to work with. I really struggle to see how how anybody can disbelieve the E. I think that I mean, I don't know who is being referred to when they say that they disbelieve the E. Whether that's based upon any evidence or whether that was just a throwaway comment of some kind. But I would say if you do disbelieve the earnings, well, you can disbelieve them all you like, but the evidence sort of very strongly points to a very different outcome and a much stronger outcome. Now, um, I guess I guess to my mind, it's quite difficult to see how this will not land on a price earnings of 3 times, based upon everything that we know. I mean, yes, the remaining 10% could be off. That could be, but I'm not aware of any particular reason why that would be the case. If anything, UK, the UK optimism, like the PMIs are stronger now in 2026 than they were in 2025. I mean, yes, there might be some adjustments so I am talking about the adjusted profit, the underlying profit, not the statutory profit. Perhaps the statutory profit won't be a PE of 3 times; it'll be an adjusted PE of 3 times. I am seeing lots of positive reviews now of the online, so it looks like that's now in the rearview mirror, but maybe it's early days to be calling that. So yeah, I just don't see the evidence at all as to why it will be anything other than what I believe and what Chief Rebel believe to be the outcome for the works. And I'm sorry, but if you're delivering a 3% net profit margin with plans and strategies to achieve a 6%, and the works have delivered. I mean, this is the thing, right? They've delivered an increase of margin. They've delivered reduced costs. They're they're in progress with the online aspect. They're delivering like-for-like store revenue increases per store. So they've also delivered some great press PR coverage for their screen-free time and their campaigning. I like all of that, and they seem to be achieving things. If you go and look at sort of other businesses, I mean, Marks and Spencers, for example, I mean, they're not achieving anything greater or better than 3%. They've never achieved a more than 3% net margin. Their latest margin is 2.1. So this argument that the works is a sort of an inferior business, I just don't get that at all. I think that it's an improving business, and as it improves, it will be incredibly cheaper than relative to its market cap. Its earnings will increase, and as it generates more cash, its indebtedness will decrease, and therefore the profits will rise through that as well. And I think it's a fairly defensive name where I just don't think that for the sorts of things they sell, which are kind of, heavy, bulky things that you would want to sort of look at and touch, and things that I suppose people that go into the works are going in there for enjoyment to some extent as well, that they have a hobby or an interest and they want to go in and browse around the books and browse around the products, and the kids kind of tug on mummy or daddy's coat and say, "Oh, let's go in the works. I want a toy. I want this. I want that." Usual thing, like nagging kids is is a great way for businesses to earn some profits, in my experience. So yeah, look, I don't agree with this negative view of the works, and I'm positioned accordingly. So I'm going to next we'll cover Marstons. I haven't done any deep research on this yet, and I just did a bit of, as you can see, I did a bit of what's the word? Adaptation of Chief Rebel's picture that he used for describing Marstons and his other ideas. So I've renamed it the Magnificent Seven, even though it's only one of the seven that I'm actually. But I did decide to relent and to buy Marstons when it dropped on the trading update, and it dropped by about 12% down to 60p, and I thought, well. I'm gonna sort of get on board with this. I mean, the full review is here at this link. The trading update, as I say, sort of said, oh yes, the like for likes was 0%, and there was a couple of mildly negative comments, but I'm not too worried about those. I mean, that's just over a very short term period of time. And what I'm interested in, particularly, I liked the fact that this is on a huge discount. Obviously, that book value being book value, not fair value. And I like the cash generative nature of it. I like the earnings potential. It's seems to be a good share position for UK recovery. When you think about all the different things, I'm not sort of hugely into watching sport, but I know plenty of people who are and are glued to the Winter Olympics. In fact, I'm going to go down and watch the Winter Olympics shortly now, and I was watching the tobogganing earlier, and so on. So, but you've got the Football World Cup this year. You've got lots of other events this year, and I like the chief executive as well. I think there's that as well. So yeah, I'm adding to that. I've added a few. I did sort of say, oh, I'm not going to add more and more and more ideas. I want to strip, cut the number of holdings I've got was my New Year resolution. I've failed in that. I've also added a PGM idea, but that is, I'm not going to say who. I'm just going to say it's not Sylvania, it's not Eurasia, It's not sort of some weird junior. I'm not going to tell you what it is, but you can certainly try and guess. I'll tell you if you're right. But I will be covering it, and I am very excited about it, and think it's a great opportunity. And I wish I'd spotted it sooner. But anyway, I've spotted it now and think it's got upside. So anyway, I'll be talking more about that soon. There's also another new idea. Again, I'm not going to say who or what it is, but with all the political stuff going on, not about thingamajig, Mandelson, or any of that nonsense, but just other nonsense around energy and around all the political stuff going on. Don't know where all of that will fall, but I do know that energy is a very crucial key area, and a preoccupation, and therefore this idea, I think, has got huge legs. It's already up a great deal in the money, but I think it's got a lot more to go, and I'll be writing about that soon. UK doom and boom. That's a deliberate typo. Again, I've had a few people say, "Oh, no, I mean the UK is not going to do well. It's in the doldrums." And I've just been looking at the evidence to that, and I just don't see it personally. I think there's lots of reasons to think the UK is going to actually have a good year in 2026. I haven't got that many ideas. I was looking at this. I mean, certainly in terms of the Outlook picks for 26, there's only a few that are actually UK. I've gone outside the UK for most of my ideas, which, I mean, not just in terms of stock market, but in terms of physically, where do they earn money from? Not that many that are actually UK economy dependent. I mean, compare myself to Mr. Rebel, for example, who's 100%, and I think he always is, 100% on UK, or maybe not actually, maybe like Zote Phones. I mean, it's US sales predominantly and things like that. But anyway, I mean, I have got, and I suppose Marstons is a good example of that. The Works that we've talked about is a good example of that. I wrote about EasyJet recently, another example of that. So I am sort of positioning more into the UK, deliberately, because of the news flow and the sorts of news flow that I'm seeing. And also I've been speaking about the banks, and not going for any of the FTSE 100 or FTSE 350 banks, but positioning into the smaller challenger banks, particularly around the private equity ones. So anyway, yeah, PMI's up 54 from 51.4. That's a good strengthening, growth at a solid pace in January. And manufacturing PMI, 51.8, up from 50.6. The construction PMI rebounded. Now it's not into positive territory, but it's at 46.4, which is a big jump from 42. So it's getting there. It's getting there. Car registrations rose by 3.4% in the year, compared to 2024. So again, quite you'd kind of look at it and think, oh, it's all doom and doom and doom. Well, it's not. I mean, despite the best efforts of the Chancellor to tax her way into whatever's, it's not. Orchard is, I don't own it, but it's been talked about a lot, and I guess it's on my radar. It was one of Mr. John's ideas last year. It's an idea he decided to keep open, so an idea he thinks is a good idea. So yeah, it's on my radar. I don't have much more to say than that. I mean, it was up 105% last year. This was a recent reader's comment, so I just sort of make a note of it. I did have a look at the Cockney Rebel Substack, and I don't think it is covered, unless I'm missing it. But yeah, I couldn't see that was the case. And that's all I was going to just quickly mention that. Next topic is just continuation of my recent article on oil be the judge of that. that oil crude inventories remain 3% below average in the US. They're 3% below. They were at the start of January. They are at the start of February. The strategic, the SPR, is 42% empty, 58% full. So remains at a very low level. Worldwide inventories are at 7.9, which is a record level. But much of that accumulation is China. So China have now got 1.5 of that 7.9 is China, and they're planning to expand that by a further 170 million barrels in 2026. So obviously that's 170 million. That's half a million barrels per day of demand, further demand from China in the current year. So it's also interesting that there's 300 million barrels sat in shadow fleet vessels that are either containing oil from Russia, from Iran, and perhaps still some from Venezuela. So actually, when you strip out those two factors, the shadow fleet storage, the China storage, you're only actually then looking at 6.1 billion barrels, which actually is below the 5-year average. Now, the OECD is in line, but the overall oil, when you strip out the two factors, China and shadow, it isn't actually at record levels at all. It's below the average levels. And I just want to call out this particularly. I do like picking out particular words in things and just focusing in on them. And the word I'm going to focus in on here is the word surged. Global observed stocks surged by 75 million barrels in November. They surged to negative. They went up rapidly. Surge. Crude oil, 96% of the increase. So why are we using the word surge when stripping out the two factors, the level of oil isn't surging, it's below the average? Yeah. I mean, yes, you could sort of say, oh, well, it's a surge when you include the Chinese demand, but even the fact that the Chinese are stockpiling, I mean, why are they stockpiling? Doesn't that slightly create a reason to isn't that in itself a potential for geopolitical risk? I think so. So I think the word surge is completely inappropriate in this context. Would it not be better to use the word surge for the demand element? After all, and they don't, by the way, the IEA don't use the word surge for is the demand surging? Well, no, they don't use that word for the demand. But they do say that so 4 months ago, they said world demand growth was 700,000, 0.7 million barrels demand growth. 2 months later, 700 had grown, surged. Oh, sorry, I can't use the word surged because the IEA didn't use the word, but it increased in 2 months by 20%, from 700 to 850. It's now grown even more to 930, which is over 30% more than it was before. I just think that when you look at these words, there's just a complete lack of even-handedness to the words that are being used for the elements of demand and supply. Now, you can see it here. Subdued. Subdued is a negative word. Demand was subdued. Only 700,000 subdued. And this is October 2025. Demand is subdued. A month later, by comparison, demand is forecast to increase by 830. So it was going to increase by 700 in 2025 and in 2026, well below, historical trend. recent strength. So even in the space of a month, first of all, they're not making any reference to the fact that they've increased their forecast. They're just ignoring the fact that it's grown by 130,000 barrels in the space of 1 month. And let's carry on, because that was the November report. Let's go to the January report. Global is forecast to average 930. Yeah. And then here, oil supply is projected to rise by 1.8 million barrels. So in January, supply was projected to rise by 1.8 million barrels. That's a lot of increase of supply. They got it wrong. A year later, Jan 26, oil supply fell by 350,000 barrels. Again, nowhere are they saying, oh, sorry, yeah, actually, supply didn't increase, it dropped. We were out by 2 million barrels per day. 2% incorrect. I mean, 2% as in there was a 2% difference to supply. I mean, these are just big numbers, folks. And I think if you actually just compare month by month by month to these reports and the inconsistency, just the lack of accountability, I think it's just genuinely shocking. Anyway, I'm not going to sort of dwell on that. I'm going to try and speed up because we're almost at an hour again. I try and do these things fast, but it just doesn't work that way. Anyway, I'm pretty excited that the DEC fourth quarter results will be out soon. I'm thinking probably this week. I think we're going to see something like $6 earnings per share. Over the next couple of years. I mean, this is not just me saying it. There's the $6 there, and there. $2.10, $2.24, $1.92 are the forecast values. Free cash flow, 787 this year, 663 next year, 467. So you're talking of a share that's delivering kind of $18 over 3 years of free cash flow. Something like $6 of earnings per share, and this is a share that you can buy for $12.60. I mean, it's incredibly cheap still, and it's under attack. Specifically, no other oil company is under attack in the way that DEC is under attack for its ARO, it's very interesting. So, I mean, this was somebody that asked me about this, and I thought, well, I'm just going to put my answer in this article to talk through the logic. So they've got 70,000 wells. Something like 23,000 of those are under an agreement with the government or the state of West Virginia. In return for 70 million, so 3.5 million each year for 20 years, plus the commitment to retire 75 wells per year minimum. Which, when you add all of that together, the plug-in costs, the per year cost, that's 5.5 million. 20 years is 110 million pounds. If you followed that same logic for the other 47,000 wells, you'd come to an ARO of 350 million. Well, the actual ARO set aside discounted is 642 million. So it's already well above the what the ARO would be on a pro rata basis. But more than that, you've got the idea that there's 728 million of equity plus the ARO. In other words, there is 1.37 billion net book value of net assets to cover the decommissioning, the plug-in costs. Plus, they have reserves of 5.8 billion, discounted at 10%. And because it's discounted, I mean, this is the thing that maybe people sort of don't understand properly. If I've got something today that is discounted for the next 50 years at 10%, the future value of that 5.8 billion isn't just 5.8 billion. It's not to say that it's going to deliver 5.8 billion. It will deliver 5.8 billion after I deduct two things. Number one, the cost of delivering whatever I'm delivering, plus the future reduction of the future value of money. So a pound today is worth more than a pound tomorrow, and worth more as well than a pound in a year's time. That the value of money today gets discounted. So in a year's time, a pound is worth 90p. And in 2 years' time, it's worth 81p. That's what discounted at 10% means. So if you don't discount it by 10%, if you just say, well, how much is 5.8 billion in today's money? Um, what you actually get to is in today's net asset terms, each one of the wells that DEC owns on an undiscounted basis equates to 131,000 dollars per well. Um, Oh, sorry. So, no, sorry. Apologies. That's on a discounted basis. So that is on the discounted basis. If you do it on an undiscounted basis, it's 662,000 per well. And I mean, this is sort of the crazy economics that I just don't think people are understanding. It's also the case that factually, the cost of decommissioning the wells, net of the revenue they get from their decommissioning business, they go and plug other people's wells and earn, about 6 million was the amount in the latest accounts. In the first half 25 accounts, they spent 8.4 million. So it was kind of 2.3 million net cost, I think it was the difference, which for the number of wells works out at a net cost of 14,371 per well. Now, obviously, if they shut down their decommissioning business, Next Level, it's called Next Level, then yes, they wouldn't be decommissioning wells at 14,000 each. If they ran out of demand, they wouldn't be earning the sums they are for decommissioning other people's wells. But the fact is, there's 2 million of these uncommissioned, these orphan wells. No, sorry, there's 2 million wells, of which the orphaned ones are at least 1 million. That ultimately are the responsibility of the state government to sort out under the Orphan Wells program, and so yeah, there's no shortage of demand, and when you actually work out, that versus that, I mean, you're talking about a 4,600 margin of safety. I mean, it blows my mind that people are saying, oh well, they might run out of money. Well, they're covered 46 times over, and that's ignoring the land sales, which are then on top, which aren't in the books anywhere. And the land sales are generating tens of millions each quarter. So I just don't think I don't think people understand it very well. And I'd also make the point, well, if you're going to do something about ARO, don't just go after one company. You should be going after every company equally, because it's vexatious to be going after a single company when I would argue offshore oil is far more complex, and the decommissioning costs of the plugging costs of offshore oil is far more. I mean, you look at the North Sea, which is a tiny fraction of the Gulf of America or Gulf of Mexico. I mean, the costs there are 42 billion. And I mean, Gulf of Mexico, I'd hate to think what the decommissioning costs are. It's much deeper water in the Gulf of Mexico for a start. And then you've got other places around the world with decommissioning costs as well. So yeah, just quickly, Unite. So I've converted over the empiric into Unite. So we're just sort of putting that in for the record. It's showing on a 13.9% gain, which I was really pleased with, because overall the picks for 26 are at 31% gain. And I think I'm right in saying that everything now is in profit. Even Greg's, which was at a loss, is now at a 1.7% profit, which I didn't expect. So what I've done here is call time on empiric, and I've introduced. So what I've done here is the amount that was paid in cash was the 1,000 minus the so I think it was £415 of cash, and then 585 of shares. So the shares kind of convert at that price, which is then compared to the market price is a 13.9% gain. So that's kind of where that plus minus 585 is coming from. I also covered Bitcoin very briefly, and do I still dislike crypto? I think these articles where I said, once Bitcoin drops and drops by a certain amount, it then basically makes all the Bitcoin treasury companies, there's quite a few of them, including a large one called MicroStrategy, they all become technically insolvent. And when they become technically insolvent and then they become forced sellers, that will crash the price of Bitcoin even further. Um, Interesting to see Cathy Wood. I've got great respect for Cathy Wood, but interesting to see Cathy Wood's got a completely different view on it, as perhaps you'd expect, that she sees it as a healthy reset. I think it's got further to fall and further to more pain ahead, and I feel vindicated at this point that it's crashed by as much as it has, because I kind of expected that it wouldn't end well, and people that were saying, oh yes, it's going to rise to 1 million or rise to whatever they were saying, I just felt it was very over egged, and I sort of said, especially the Bitcoin treasury companies. I mean, it's a very dangerous trade, and part of me kind of would have shorted against them, really. I sort of I think I described it as inverse sailor, as in the CEO of MicroStrategy, or strategy is Michael Saylor, that just bet against the guy, because it seems like a surefire thing that it's going to crash at some point. And when it crashes to the point, because they're paying bondholders, they've got a lot of debt, they've got debt interest, they've got shareholders that they're paying a dividend to, that, I mean, presumably they're going to have to can that off then, and that'll drop the share price. But at the price of Bitcoin, the Bitcoin is as I say, the bondholders, the debt holders, are owed more money than the assets of the company. So it's a very I don't know what will happen, but and I just wanted to kind of present the opposite view, which is what Cathy Wood presented, which is it's a reset. It's Bitcoin is still a flight to safety, in her opinion, that it's a digital gold, a digital alternative to fiat currency debasement. And I think, there is an argument to say that that is true, but it's also the case that Bitcoin comes with a cost, and who's going to pay that cost? Um, it's also the case that at the current prices of mining Bitcoin, it's not economic to mine Bitcoin. So if you get a collapse of supply, like, how is Bitcoin going to remain operational if there's nobody mining it? Like, who 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 manages and operates Bitcoin if there's no one operating it? And that's always been the catch 22, or the irony of Bitcoin, is that it relies upon people mining to carry out the transactions that support the network, because there's no Bitcoin server anywhere apart from the people doing the mining. The people doing the mining are the people doing the processing. But how are they going to do any more mining and therefore processing when it's not economic to do so? And if it drops further, then it's even more uneconomic to do so. So I just don't understand essentially it felt like a Ponzi scheme, and I think that's proven itself out. However, there is quite a lot of institutional support for Bitcoin. So I looked at institutional investor support. JP Morgan is very supportive. BlackRock, very, very supportive. I do kind of make the counter to that to say, well, maybe they're supportive because they've got skin in the game. The IBIT, which is the ETF that BlackRock run, has 800,000 Bitcoins in assets under management, $52 billion worth. I mean, maybe that 52 billion isn't quite 52 billion anymore because the price has dropped, but yeah, they've got 3.8% of all the Bitcoins which they manage, which is obviously a large amount of money. And then JP Morgan obviously will earn fees from leveraged and structured products that they sell. So like a leveraged Bitcoin asset might be one of those complex products, so therefore they benefit from Bitcoin trading. Anyway, that sort of concludes what I was going to cover. Very long article. I think we've got there, and we're at an hour, so I'm going to draw a line under that. I hope that's been useful. Do like and subscribe, all of that fun stuff, if you would. Really appreciate your support, and look forward to covering some more stuff, and some of those ideas that I've cryptically mentioned, that you'll learn more of in the next, whenever I write the article, basically. Okay, cheerio for now. Cheerio.